Hey everybody, welcome back to Actual Investing. Today we're going to be talking about two small stocks that I have my eye on. I think both of these could be good buys right now, but I want to dig into them a little bit more. So let's start with the first one, Axcelis Technologies, ticker ACLS. Axcelis is an interesting company because they produce equipment for the semiconductor manufacturing industry. Specifically, they design and manufacture ion implantation products. Though you may have never heard of ion implantation, it is a crucial step in semiconductor production, and as the demand for new semiconductor chips grows, the demand for ion implantation machines is also going to grow in tandem. It's especially useful for silicon carbide or SiC chips, which are a bit more energy efficient, but can also be a bit more expensive. However, these types of chips are being used extensively in electric vehicles and clean energy projects, two themes that I think have some good tailwinds in the next few years. So why do I like Axcelis? Well, it's an exciting company, but it's also cheap. Now, obviously, cheap is a very relative and subjective term, but what I mean is that their valuation, I think, is quite low, especially compared to other semiconductor stocks out there right now. When we look at just the stock price chart, we can see that Axcelis has dipped 37% in the past year and is down about 50% from its high back in 2023. So just because a stock is down does not automatically make it cheap. We need to actually look at some valuation metrics. So let's start with PE, because Axcelis, even though they are technically a growth stock, are profitable, and their PE ratio currently sits at just under 14, which is quite cheap compared to the NASDAQ average, which is the exchange that Axcelis trades on. Additionally, we can see that they have a market cap of about $3.3 billion with quarterly revenue of $250 million. This gives them a price to annualized sales. I'm essentially just taking this last quarter, multiplying it by 4, and then taking the market cap and dividing by that number. That gives them a price to annualized sales of just 3. Both of these metrics, PE and price to annualized sales, are lower than the typical stock that I analyze. So that's the first thing that makes me think that this company may be cheap. The other thing that's interesting about Axcelis is that on a price to free cash flow, they're also lower than the typical company that I analyze. With free cash flows of $136 million last year, and again, a market cap of just over $3 billion, that gives them a price to free cash flows of about 24. For reference, the average company in my portfolio is around 40. So this is, on all metrics, cheaper than I would expect for a company that does have a lot of growth potential. In looking at their financials, we can see that they have pretty strong gross margins for a hardware company. Like I said, they make hardware, that ion implantation hardware for the semiconductor industry. So typically when you're selling physical hardware, it's really tough to have strong margins because other companies are going to come in and try to undercut you, especially when you're a little guy like Axcelis. But Axcelis has really solid gross margins of over 40%. We can see that their gross profit is $112 million in the last quarter, with total revenue of $257 million. That gives them a gross margin of 44%. When we look at my high quality companies spreadsheet, I've listed out all of these metrics we talked about for Axcelis so that we can see how they compare to some other small cap stocks that I've got my eye on. Like I said, gross margins of 44% are quite solid, and while we can see other companies outpacing this, these are mostly software companies, not hardware companies. What I also like is that Axcelis isn't spending too heavily on their SG&A, which is selling, general, and administrative, or their R&D, which is research and development. The two combined only make up about 50% of their gross profit. And finally, one thing that I love about Axcelis, and that I also think makes it appear to be a good investment, is their amazing balance sheet. They have a debt to equity ratio of just 8%. Essentially what this means is if you took the entire book value of the company and you took the entire value of the debt and you divided them, debt over total equity, it's only 8%. So with total debt of just $73 million, they're looking pretty good. So Axcelis, to summarize, we have a company that has decent gross margins for a hardware company. They're not spending too much on their operating expenses. They have a nice clean balance sheet. They have a pretty low valuation in terms of price to sales and price to earnings and price to cash flows. And their revenues are geographically diversified, with 87% of sales coming from countries outside the United States. The only thing I don't like on this spreadsheet is their negative year-over-year revenue growth. Even though semiconductor stocks have done really, really well lately, the broader semiconductor market is actually still in a downturn. You wouldn't guess that because of how well AI semiconductor companies are doing, but in the automotive and industrial industries, which is where Axcelis primarily caters to, they're still seeing a downturn. And that's why big companies like Applied Materials are showing pretty flat revenue growth year over year as well, despite also catering to the AI industry. They're being bogged down by the weak automotive and industrial markets. However, both of these markets are heavily tied to the economy. So as the economy improves, both of these sectors should improve, boosting Axcelis' sales, we would hope. But even if it doesn't, the fact that just based on the earnings that they have right now and the free cash flows that they already reported, the company is still looking quite cheap. Looking at Axcelis' investor deck, we can see that they claim to be well positioned for long-term growth, like I mentioned earlier, with silicon carbide, which is used in industrial and automotive applications, a market recovery in memory chips, and an increasing market share in advanced logic chips. Additionally, they are expanding geographically into Japan. I love to see that they break down the bull case for you right here on their investor deck. Now, finally, we can't just look in the rearview mirror and say that this company is cheap. We need to look forward and give our best guess as to what the company is going to do in the future, because the market is always forward-looking. So Axcelis does provide outlook for the next quarter of $255 million, so pretty close to what they reported in Q2, but they say Q4 revenue is going to be slightly higher than Q3. So in my mind, what we're seeing is a bit of recovery from Axcelis and potentially a return to growth. Looking at their income statement, we can see that before this year, where they had negative 6% year-over-year growth in the past quarter, they were showing really strong double-digit revenue growth year-over-year consistently since 2019. So I do believe that this small blip is nothing to be too concerned about. I think that Axcelis' key markets are seeing a lot of headwinds, but that they should recover in 2025 and 2026 as interest rates fall and the economy begins to improve in the US and internationally. So that's my thesis on Axcelis. Please don't just buy the company just because I like it. I'm going to continue to do some research on this company before making any investment decisions, and I will alert all of my YouTube members if I decide to buy shares. For those who don't know, I do offer a YouTube membership. It's about $2 a month, and you can see all of my trades on my YouTube membership page. I'm also looking to improve this so that I can, deliver some more value to you guys. So I'm also hoping to start doing some members only videos and things like that. So stay tuned. But even if you don't want to become a member, that's totally fine. If you're liking this video so far, please hit the like button and please subscribe if you're new. All right, shameless plug is out of the way. Let's go on to the next stock. That's a small cap stock that I have my eye on. And that is a probably not very well-known company. It's a small company called Bristow Group, and the ticker is VTOL. If you're confused why a company called Bristow Group has a ticker VTOL, it stands for Vertical Takeoff and Landing. This is a helicopter company. Bristow owns and operates a fleet of helicopters, and they provide helicopter transportation services, mostly for the offshore energy industry, things like offshore drilling for oil and gas. But they also offer government services like search and rescue and emergency medical. Essentially, if you need to get to a remote location, Bristow can take you there in one of their helicopters. It's a really cool company, but just because it's a cool company is not the reason that I am thinking about buying it. I'm thinking about buying it because, like Axcelis, a lot of the metrics that I follow look cheap. So if we look at price to sales, we can see that Bristow is currently trading at less than 1 times annualized sales. This is incredibly low, but it doesn't by itself make the company cheap. Let's look at some other metrics. Price to free cash flows, if you take the most recent quarter and annualize them, is 8 times. Anything in the single digits, in my mind, is very, very low. Typically, like I said, I'd see companies around 40 times free cash flows. This is especially impressive because Bristow is growing at double digits. They grew their revenue 17.7% year over year in the recent quarter. While their PE isn't necessarily low, it's also not terribly high at 34. I'm okay with that. With international sales of 70%, Bristow also has a nice diversified revenue stream. Okay, so that was the bull case. A couple things I don't like about Bristow are their high debt to equity ratio, because this is a pretty capital intensive business, right? They have to buy helicopters and maintain them and look after them. And additionally, they are not terribly profitable. Let's take a look, and so I can show you what I mean. When we look at their income statement, we can see that they just started showing a meaningful profit, whereas historically their net income as opposed to their revenue is just a tiny sliver. So I like to see that their net income is growing along with their revenue, but I don't like that these are very, very slim profit margins. Just 8% in the last quarter. It's not bad, but it's not very healthy. However, I think you're rewarded and compensated for this with the low valuation. And like I said, the price to free cash flow is very attractive. So they had $33 million in free cash flows last quarter, and this has been on the rise. We can see that the previous quarter it was $22 million, and before that they actually had negative free cash flow of $10 million. So their revenues are growing, their earnings are growing, and their free cash flows are growing. I love to see that. So you might be wondering at this point, how is a helicopter company managing to grow this much? It doesn't sound like a very exciting tech company. It doesn't sound like it has a lot of growth drivers. Well, it turns out Bristow has found itself a really nice niche. Helicopters actually play a really big role in offshore drilling and wind farm maintenance. So whether you are a big fan of clean energy like I am, or whether you believe that oil and gas are the way to go in the future, Bristow can help with that. So as we can see here from Helicopter Express, helicopters like Bristow's, now this is not a Bristow helicopter, but this is an example, can be used to reach remote areas such as offshore wind and offshore drilling applications. Helicopter Express says helicopters are key tools in the energy industry, used in the installation and maintenance of power lines, tools to inspect and monitor infrastructure, and transportation for crews maintaining countries' energy grids in remote locations. So, this is a bit of a stretch, but as you know, energy demand has been increasing, right? Accelerated computing is using a lot of energy, so AI applications, as you can imagine, require large data centers, and these large data centers have a lot of electrical components that are moving very quickly and heating up very fast. And all of this uses a lot of energy. So the thought here is that we're going to need to generate more energy to compensate for this high energy demand. Now, stay with me here. Whether you are a fan of wind energy or oil and gas, Bristow and their helicopters provide a way to maintain these crucial energy infrastructure systems. So I believe that's why Bristow has been able to see some growth. Additionally, they're a small company at just a $1 billion market cap, and companies that small are a bit more nimble and can grow a bit quicker, right? Looking at their investor deck does give me a bit more confidence in my thesis here, with 66% of their revenue coming from offshore energy. So I believe as energy demand continues to increase, companies like Bristow should stand to benefit. One thing I really like about Bristow is that they have really nice investor relations. They give these really good detailed metrics in their earnings presentations every single quarter. One that I especially like here is their outlook. They provide outlook for the next 3 years. So they're estimated 2024 through estimated 2026. They call it a target, not an estimate for 2026, but it's so far out that it's really hard to estimate, I'm sure. However, I think that this is really helpful in analyzing the company because we can see how they're expected to grow and see if they meet those expectations. As we can see, they raised their guidance for these next 2 years, which is really nice to see. So if we do the math here and we look at their total operating revenues, they're looking at about 14% revenue growth from 2024 to 2025, and then another 10% from 2025 to 2026. So we're looking at double-digit revenue growth for this year, 2025, and 2026. 3 years of double-digit revenue growth. That's really awesome to see. And it's not just the revenues that are increasing, but their earnings as well. So earnings before interest, taxes, depreciation, and amortization is expected to rise steadily over the next 3 years as well. I love to see that. If we want to see where this new raised outlook is coming from, we can see that they're actually expecting a lot more revenue from international customers in Africa and Europe. Very cool to see an internationally diversified revenue stream. That really helps when times are tough for one country. Okay, and the downside is, like I said, this is a capital-intensive business because owning and operating helicopters is not cheap. What we can see is that they have just under $200 million in cash and total liquidity of about $250 million. They do have $400 million of debt coming due in 2028. That's not soon, but it's also not too far off in the future. So somehow they're going to have to either pay off or restructure this debt that comes due in 2028. They have $250 million of liquidity, so that's most of it, but there's still another $150 million that needs to hit their balance sheet before 2028. That's where those free cash flows come into play. As we can see, free cash flows are increasing. So if they keep this up, let's just say that their free cash flows don't change in the future. It'll only take them about 5 more quarters of this to get enough free cash flow to pay off that debt that comes due in 4 years. So that debt looming in the horizon isn't actually that scary. It's also not at a horrible interest rate at about a 6.9%. Could be worse. Could be better, could be worse. Finally, if you're a helicopter nerd and you're interested in what kind of helicopters they own and which ones they lease, they give you a whole breakdown of their entire fleet. So they show their owned aircraft, leased aircraft, and total aircraft, as well as how old the aircraft is. So we can see that some of these are getting up there in years, with one of them being 35 years old, but most of them are in the teens. We can see that the average age of all their helicopters is 14 years, and that they have a total fleet of 200 helicopters. Not bad for a very small $1 billion company. So that's Axcelis and Bristow. Those are the 2 small companies that I have my eyes on. Both companies are cheap on my typical valuation metrics. Those are price to annualized sales, price to earnings, and price to free cash flows. Both of them, I believe, should continue to grow their revenues in the near future. Obviously, Axcelis is experiencing a bit of a hiccup right now, but I think that they can return to growth. And both of them are geographically diversified which should help them to see some resiliency. It's really hard to find small companies that have geographically diversified revenues. A lot of the small companies that I look at are strictly in the US. So let me know what you guys think of these two companies in the comments below, and if you have any other stocks you'd like me to cover, please also leave them below. Thanks so much for watching, and I hope you all have an amazing day.